Welcome, everyone, to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe, and for those of you that do, thanks for checking me out again. As always, you can check me out on social media at EveryTimeICash. You could reach out to me directly on my website, everytimeicash.com/contact. If you find this content useful, please don't forget to like, rate, subscribe, and comment below in the comments section. Comments are very helpful. They help me understand what it is that works and what it is that people find useful and what it is that I can actually spend time on versus wasting my time and ultimately your time. So please don't forget to leave a comment below in the comment section and to like it if you find it useful. This is going to be a video. It's going to be a quick video and an audio podcast. You can check out the audio version on my podcast channel, Every Time I Cash. You could also check out the video version on my YouTube channel, which is, again, at Every Time I Cash. So this is going to be a quick video. It's going to be about the last 2020 volatility event. 2020 has been a very volatile year, and we've made it to the finish line. There is one last scheduled volatility event, which is the Fed meeting and Jay Powell himself speaking tomorrow. So we have that to look forward to, and this is going to be a quick video covering some of the thoughts that I have, some of the logic that I'm using going into that event. I will try to make a couple more videos in the next couple of days, one for chart bombs. I'm going to highlight a couple of things that I watch for trading. I know I said that last time. It's going to be coming out soon. I got a couple things in the works for 2021, so please look out for that. Don't forget to hit the notification button on YouTube and on the podcast channel as well to get updated as soon as I have new content. So please go ahead and do that, and it'll save you some time and save me some time as well. So without further ado, I'm going to just go ahead and dive into it. If you're checking out the video version, you're going to see that there is the Russell 2000 futures chart on your screen. This is a chart for the last 2 years. You're going to see that we've been in a very wide range for the last 2 years, basically a consolidation pattern for the last 2 years, and that we recently broke out back in early November. I covered this in the last video that I posted, so if you haven't checked that out, you'll find more depth there. It'll be very useful. I think it's going to be very helpful to understand how my logic is and how things are moving forward. But we essentially broke out of this range. We broke out, the first attempt we had was November 9th, and we've been grinding our way to the top. Now, if you zoom in for 2020, we tried to test the 1700 level and break through it early in 2020, and we failed before ultimately we had the COVID rollover and the entire market took a shit. Since the middle of March, where we bottomed, which was like March 19th, we have been in this upward channel in the Russell in particular, and it's been tested 3 times now, and we've held and we've pressed up against highs. Now, the last video that I posted, which was about a week ago, I highlighted that we were at the deep end of the pool and things are stretched, and I'm looking to be cautious. Now, I want to illustrate again that I'm still cautious. Now, caution is not something that I'm looking to short. I'm not looking for disaster. I'm not looking for, the same thing that happened in February to happen again. It's just to be cautious. It's just to kind of take some chips off the table, understand that you're in the deep end of the pool, and that any little headline, any bad thing that is unexpected can lead to a precipitous drop, or it could wipe you out before you could react to it. So that's essentially the point of caution. I'm going to bring up a couple of slides from the last video. So this is the first slide. It was highlighting what sectors were performing through the month of November, going into the last month of the quarter. And essentially, we were being outperformed by the laggards. So you had financials, industrials, and energy leading the way. And these are all cyclical, global recovery, reflation trade, whatever you want to call it. This is all basically the benefits of the Russell. if you look at it on the second slide that is on your screen, I brought this up as well, that historically when you get the Russell breaking out the way that it did, and when you get the Russell outperforming the way that it did, ultimately, historically speaking, you've had pullbacks from those highs that have given you an opportunity to buy back at significantly lower levels. So this is a 40-year time horizon essentially, and on average we've gotten a pullback of 7%, and the median pullback's been about 6%. So historically speaking, when we've gone, parabolic basically, we've had opportunities to buy back the Russell, and that those opportunities have presented themselves within essentially 30 days. So, I'm not here to preach, super negativity or suggest that I'm wildly bearish or I'm, the sky is falling. No one's doing any of that. And could we just bust through and continue to go up? Sure. We've got seasonality on our side. We've got a bunch of things on our side. So it's going to be very difficult to, get meaningful losses. But essentially, I'm just cautious with my money. I don't want to give back the gains that I've had in 2020. I've had a solid year. I don't want to give them back. So, I'm just being the word that you hear on television, you hear, on podcasts, and you see in print is tactical. So essentially, you want to be tactical. So I started by highlighting this 2-year range, and ultimately there is the 1750 level on the Russell that functions as that 2-year high, the previous high basically, which coincidentally coincides with this 50-day. So if we get a little bit of a sell-off, ultimately I'm just looking to be a buyer of that dip. So could it get a little bit more extended? Sure, but that's essentially what I'm looking for. I'm looking for a little bit of a reset. It could happen now. It could happen after the Georgia runoffs. It could happen because COVID, gets out of control and no one can stop it, and more people are dying than we expected. I don't know what can trigger it, but all I'm saying is that I like to exercise caution in these situations, and I like to keep that in the back of my mind, and I like to highlight different targets for entry rather than just press my bets and press my bets and press my bets. Now, that being said, move on to the S&P. S&P has been a little less of a performer. It's still at an all-time high. No one's saying, short the living daylights out of it. This is the top. No one's saying any of that. Just saying that you want to be cautious, you being me in this case. I want to be cautious anytime I get to a situation like that, and I want to identify levels of support. So first level of support I want to identify is that 3590 level, which was a prior high. Ultimately, we have the 20-day that functions as our support. If we break through that 20-day, I want to see the low that we set on December 11th act as support. If that doesn't act as support and we blow through that, then I'm just looking at the prior high, and then I'm looking at the 50-day as support there. Now, the one thing that you may have noticed is that while the market was consolidating, we've basically gone nowhere since the end of November. So since December 1st, we had the market close at 36.63 essentially, and today, as of right now, we're at 36.90. So that's basically 1%. 1% can get wiped out in 30 minutes in this market on the back of some Mitch McConnell headline or something like that. So the driving force that I want to focus on into this Fed print is we all know that the Fed's not going to do anything to disrupt status quo. Status quo here being they're going to be accommodative. They're not going to build this bridge and then just destroy it just to destroy it. At least we hope not, right? But there are some things that the Fed could do that could spook the market. So the first thing that I want to pay attention to is if the Fed just does nothing, right? So if the Fed comes out and says, "Hey, we remain along our path. We still think COVID is going to be a concern moving forward. We'll be there as a backstop, but we're not going to do anything right now." Like, does that tilt people's hand into just being like, "Oh, does the Fed know something that we don't know?" and create some sort of selling? That's the first thing I want to ask. The second thing is the Fed's made it known that further fiscal stimulus is going to be welcome, and with headlines moving in the favor of a potential deal moving forward, they could just tell you that they're going to hold off on that for now, right? So if they tell us that they're going to hold off on that kind of stimulus, how's the market receive that, right? So those are like the two main things that I want to pay attention to. And it's important to know that like doing nothing is still a dovish thing. Dovish, easy for me to say. So it's still a dovish thing, and that's still something that is positive by and large. And then them backing the market's still a positive thing, but it could be received as negative because people are just juiced for wanting more right now. So ultimately, the Fed could just decide, you know what, we're going to kick the ball back into the government's court. We're going to kick it back into Congress's court, and we're going to make them disperse that money, and we're going to make them take action. The Fed told us last time that they can just print the money, they can make it available, they could be accommodative, but they can't actually put it in your bank account. So there could be a situation where the Fed decides that they're going to just force the market's hand. That's one. The second thing is if the Fed just goes out and they're overly aggressive, it could be an instance where it's going to be perceived as negative as well, because people could say, hey, what do they know that we don't know? Right. So these are just the three things that I want to watch for. They're the three things that I want to see. And I want to see the 20-day hold. And if the 20-day doesn't hold, which is basically 3630, I'm looking for the 50-day to ultimately get tested. First stop being that prior high. I want to bring up the NASDAQ because the NASDAQ showed you exactly how quick things can fall. So just a couple days ago, December 9th, we had a new high outside reversal day, and within 2 days we were testing that 20-day. Now we're holding. It's solid. No one's saying this is the end. No one's saying, the sky is falling, blah, blah, blah. Just saying I'd like to be cautious in these situations. I like to know my levels. I like to know where the 20 days at. I like to know where, inflection points are at. So got the 20-day, and then I got 12,100, and then ultimately 50-day, and then 100-day as support on the downside if things got funky for whatever reason. The last one is going to be the Dow. Dow's the most constructive of the bunch for me. It's moving sideways. The longer that it could oscillate between 30,000, call it 30,300, and 29,000, the longer we could just stay back and forth in this range, the more torque can come with the breakout if and when that happens. So I like the way things are shaping up here. I like the 50-day acting as support with the prior high at the 29,000 level. So if we just go back and forth, back and fill for a little while before we break out, that'd be great. Ultimately, if you're a bull, you want to see this kind of action. You want to see things go back and forth. You don't want to see things just go up and away, because the longer that you can stay sideways, the more tailwinds you'll have at your disposal. We're going to have a new calendar year here coming up. We're going to have the Georgia runoffs here shortly. And if you get some sort of like consolidation or some sort of mean reversion before these events happen, then you have a situation where people are going to be more apt to buying a dip or buying on the back of some weakness than you would if things just stayed grinding higher. As it grinds, the higher it grinds, the less people will participate in that move. Now, the next thing I'm monitoring is the dollar. Not ironically, the dollar peaked back in mid-March. It peaked simultaneously with the bottom of the market. Now, who knew when the Fed prints more money and you get more of that cash being printed, then the dollar goes down in value. Who would have thought that, right? So obviously the primary derivative of the dollar that people watch currently is Bitcoin. Bitcoin consolidating just below that 20,000 mark. I've maintained for the better part of this year that it's my largest holding. Currently, it's not. I'm pretty neutral Bitcoin. I'm just waiting for that 20,000 to break. The last thing that I want to watch is gold. Gold essentially tested its 200-day, had an abandoned baby, I guess you want to call it, and we're back above that 20-day, and we're pressing up against a downtrend. So if gold can catch some legs into 2020, I want to see how that behaves. Those are like the main things. The thing that I'm going to point out in SPY is that we have a situation where uh, the SPY shows you that we've been in an uptrend since November 6th. It shows you that we've tested that uptrend several times, most recently yesterday, and that we've held by and large. Now, if you don't watch, futures, if you don't watch S&P cash, SPY is fine. 20-day coincides with that. If 20-day breaks, prior high, 50-day. So these are just the ways that I map these things out. I put a roadmap potential online. I'll put it in the description again. Ultimately, you get, a dip, you get some buying, you get some consolidation near highs, you get an unexpected headline, you get more digestion, and then the hope is that the resolution happens, to the upside. Now, the longer the consolidation, the more of that tension that you work off, the further it could go once it actually breaks out. So I'm not saying the sky is falling. You want to be, sell your house, sell everything. No one's saying that. Just saying, be cautious at the top. That's what I like to do, and ultimately, we'll see what our boy Jay Powell says tomorrow. I'm gonna put it back on the Russell for you just to show you once again where we are now. As always, I'd like to say thank you. I'd like to say stay safe. I'd like to say stay profitable. And as always, please stay locked in.